Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
Hello and welcome to the COB on this Tuesday afternoon, Rates Day. My guest host in studio is Martin Crabb, who is the CIO of Shaw and Partners. Let's take a look at this local market though very quickly because I'd like to get to the analysis. Interesting to see at 2:30 p.m. we saw an initial little spike up in equities. I mean little, but we actually closed lower than we were going into this first interest rate cut that we've seen here in Australia in 4 years. So obviously we've been keeping an eye on the Aussie dollar. It was really choppy around that decision, around that 230 mark, and it's currently sitting at 63.5. So where it was sitting at about 11 o'clock, as you can see, 11:30, round about there. So the banks, the big banks, as far as our sector check today, they've all decided to pass on that interest rate cut in full. CBA cut, ANZ cut, Westpac cut, NAB cut. Hard to say or see them doing otherwise when you consider how long it's been between drinks since mortgage holders have got any relief. So you can see some of the pressure coming through on some of those big banks. Look, rates is clearly the key theme of the day, but reporting season a very, very close second, or, for you equity investors, perhaps even more important. BHP saw steel and copper demand recovering after the profit slumped to a 6-year low. Dexus pitches Australia as a safe haven. It's planning a $2 billion asset sale. HMC Capital surged on upbeat earnings and a potential Healthscope bid. Challenger posted normalized net profit of $225 million. It suffered after it came in lower than consensus. Judo, it reported first half underlying pre-tax profit of $56.7 million. That's up by 33% from last year. And the list goes on. Seek had a good day after its profit came in at $143 million compared to just $29.8 million a year ago. And Deterra reported net profit for the half year after tax down 19% on the previous year. Its share price suffered. So did Reliance Worldwide. FY revenue growth outlook coming in the mid-single digit percentage points, so lower than the consensus estimate of 10% growth. We spoke with the CEO, Heath Sharp, a little bit earlier on. That's up on the website in our reporting season coverage. In the smaller end, Monadelphous, great day. It's profit after tax up 42% from last year's levels. And Reuters has a bit of an exclusive. We don't have time to go into it, but that Woodside is in talks with at least 3 partners for its Louisiana assets. Of course, Woodside had a bad day on market yesterday. Some concerns over its dividend going forward after a resource update coming through. Let's get straight to it though, because I do want the analysis on what has been, by any standards, a big day. Martin Crabb joins me from Shaw and Partners.
Good to see you, Nadine.
So, one and done. It was hard to read what Michelle Bullock was saying. I mean, I know she's a plain talker.
Yeah.
But not telling us where the neutral rate would be.
Yeah, and it's like we need to understand as market participants where equilibrium is for inflation, unemployment and interest rates. And the only thing we really got from Michelle was they're targeting 2.5% inflation. She was pretty vague when asked about where do you think the right level of employment is. Are we at full employment now? And where's our star? Where's the neutral cash rate? So she kind of has walked back where the futures curve was. So she said the futures curve was pricing in 3 rate cuts prior to today, so 2 after today. And she said that's unrealistic, I think was the word she used, because based on their assessment, if cash rates do what's on the screen there, we're still at too high inflation, so they need to do more work. So you can see there the market, and it'll trade again tomorrow, but we're looking at sort of a 3.6% cash rate somewhere out in the middle of next year, and that's an extra couple of cuts. So she's kind of saying that looks unrealistic because that won't get us where we need to go. So I think more people are scratching their heads than anything else. She also made reference to we've just removed the rate hike that we did back in November. So everyone forgets that they hiked rates back in November. It wasn't that long ago. So I think they're just turning around and acknowledging what everyone said at the time and saying, why are you putting rates up?
Yeah.
So I think they're just kind of going back on November. They'll never say they made a mistake because you just don't do that, right? You never admit you're wrong when you're a central bank. You just underestimated or misestimated. You're not wrong. Mm-hmm. So I think it's added a little bit of uncertainty to the rate outlook. We're not going to get 2 more cuts this year. according to Michelle, unless we get sustained improvement in inflation, and they don't see that happening at the moment. And with all this tariff uncertainty out there, no one really knows what's going to happen to inflation. So yeah, we could be one and done. Unfortunately, for those of us that have a mortgage, we get a little bit of relief, and thank you to the banks for passing it on straight away, but not enough to send you off to Europe for your skiing holidays.
Yeah, certainly not in the summer. And that is Governor Bullock to you. But it was interesting to say that she said the board remains cautious on prospects for further policy easing. I mean, that's as hawkish as you can get, correct?
Yeah.
All right. Now we talk about what happens to particular companies.
Yeah.
Because we have had an interest rate cut. Yes,
Yes.
good point. Only walking back what we had come through in November, which was a surprise. Do you start to consider some of those companies, or is it too early to think about companies that benefit in a rates environment?
So one of the investment banks that we work with have done a lot of work on, stocks that perform well in rate cutting cycles. So you go back in history and say, right, okay, they started cutting rates here and they ended cutting rates there. Let's look at what stocks did. And obviously the more economically sensitive you are, the better you do. So I don't know if we're in a rate cutting cycle. That's not what I heard from Governor Bullock today. I heard, we're a little bit uncertain on the outlook for rates. So are we in a rate cutting cycle? If we are, there's a group of stocks that we've identified with our partners that look good. And two that we've added to portfolios recently are Dexus, who reported today, and also Metcash, which is a slightly different balance date, so they won't be reporting in this reporting season. Just because A, they're cheap, they're both 11, 12 times earnings, so you're not paying a lot to get the exposure, but they're also both quite cyclical. So obviously Dexus is more a play on office and the recovery of people going back to work and maybe rents continuing to move higher as occupancy rises. And Metcash is obviously a bit of a grab bag of assets. The probably most attractive is the hardware business, because if the economy is going to start picking up again, then people are going to spend money on home improvements and those sorts of things. So you get a bit of leverage to the economy and you're really not paying a lot. Just remember the market's on 18, 19 times. These stocks are on 11 or 12, so they're quite cheap. So I think that's a smart strategy, is to add some cyclicality to your portfolio. We're in a rate cutting cycle. It may only be one rate cut, but at least it's in the right direction. And history suggests you do well out of cyclicals.
But just to push the point on Dexus a little bit, so you like that one because not only does it have that tailwind of rate cuts, but it's got, that change in sentiment. What is it, a paradigm shift? I don't know what it is yet, but it certainly seems as if more people are back.
Yeah, it looks like the office market has bottomed globally because they got belted by a combination of rates. Office prices were way too elevated, so they had to come down a bit. A whole lot of supply came on in a short period of time, and all of a sudden there was this glut in office because no one was in coming into the city. And anyone who's watching this who isn't a CBD, you'll just notice the difference. And when you start seeing headlines like government departments and corporates saying it's not 3 days anymore, it's now 4, and you'll get people saying 5. There are people saying 5 already. We want you back at work. We think it's better for you. We think it's better for the business that you're back at work. And you'll start seeing occupancy rise. The other point, Nadine, is the replacement cost for buildings is significantly above where they're trading. So there's going to be no new supply. In fact, I think Jones Lang LaSalle said no new supply in Sydney for 3 years post 2026. So there's no new buildings going up. There's nothing being planned because you can't make it work.
Yeah. Okay. That kind of dovetails to results. Today I mentioned Judo Bank, and I'm thinking about rates, I'm thinking about the economy. But things were going all right for Judo pre-interest rate cut today.
Yeah. So they're more of an SME bank. So they're a small and medium enterprise bank, and they've been doing really, really well. It's interesting, the tale of two cities is you had Bendigo and Adelaide Bank come out yesterday with an absolute shocker because they chase market share at the expense of margin, which, so banking 101, you just don't do that. Judo Bank is very, very focused on the SME market, which is going well, and corporate capex spending is starting to pick up. This little rate cut is, again, we talk about a little bit of relief for people who've got mortgages, but for businesses that are looking to lend, they know their borrowing costs aren't going up. They're maybe not going down a lot, but they're not going up. And that means that SME lending is picking up. We know the big four are shedding share to private credit, but also players like Judo Bank. So again, really good result from them. I think another one that was out today was Hub. That had a really good result. It was up 10% at one stage, gave it back a little bit. But these other stocks, ARB, that's auto parts for four-wheel drive, so that's very a consumer discretionary stock that did well. And BlueScope held on to some very, very strong gains from yesterday.
That's what I was going to say. So yeah, when we were thinking about tariffs and which companies could benefit, we had flagged BlueScope as one of them. I'm sure we talked about it.
We did.
It was interesting to me that in the initial media release, there wasn't any reference to tariffs because, of course, it was Control F, but it obviously came out in the analyst call and stuff. So BlueScope, were those significant gains? And I can't remember exactly what it was yesterday, but
it was like 12
double
or 13%.
digits. Was that justified?
There was two parts. One is that people realising that it's not just a steel company; it's an Australian building products business. And if you remember back to the Seven Group result, their Boral business performed really, really well. So Aussie housing is starting to pick up from pretty subdued levels, but we're starting to see some really good results coming through. So I think people looked at that Australian building products business of their Australian steel products, ASP, part of BlueScope, performed really well, and their outlook was positive. And then they also mentioned that they're probably a beneficiary of tariffs in the US because they've got quite a lot of production in the US that's competing with Chinese imports. So that didn't drive the numbers, but it certainly drove sentiment, as you say. On the call, it's like, well, hang on, can I get a stock that protects me against this tariff? Or like, if it gets really bad, what can I own? Yeah. And it's like Ansell and these guys and a few others. So they're worth having in the portfolio. And
Monadelphous, I mean, we don't talk about it a lot.
No.
But what's that proof to you of that it did so well? Because those were bumper numbers.
Yeah, I think, I didn't look at the results, to be honest, and it's not one that I've followed for a while. We haven't covered Monadelphous at Shaw & Partners for a few years now, but I just think that, that generally it's a good business. Mining services are doing well. Iron ore production's holding up very strongly. Costs were a big issue for these guys. I think they're sort of managing their margins a bit better, but I didn't really look at that one too closely, Nadine.
Mm-hmm. Okay, and so now we've got this first interest rate cut under our belt, and we get wages data tomorrow. We've got, it seems as if not as many headlines coming out of the US. Can our market pick itself up toward those sort of intraday record highs or record highs yet again?
Yeah, I think so. I mean, you always get this phenomenon in reporting season where the good companies come out early. And then as you get closer to the end of February, it's like all the cockroaches come out of the cupboard sort of thing. So we do tend to get this thing where we get these upgrades in the start of the reporting cycle and then downgrades toward the end. Having said that, it's a really mixed bag. Like, it feels like the economy's picking up. It feels like, CBA had a slide about spending picking up and people, still saving quite a lot, but also spending quite a lot. Tax cuts coming through, lower interest rates. It feels like it's better. And so I'm still very, very positive on the Aussie market and the global market. Global market's got a bit more uncertainty, but I think the momentum in earnings is what we're really watching. And so far, so good on that front. We've seen more. We've seen 4 upgrades to every downgrade so far. So that's a pretty good ratio, right?
Sure is. So far, so good. All right, Martin Crabb, CIO, Shaw & Partners, thank you so much.
Thank you.
All right, we will just very quickly take you through some of the leaders and the laggards because I think we've probably touched upon them all. But first, BHP, the verdict from Luke Laretive from Seneca Financial Solutions and Mark Moreland from Value 3.
If you go through this result kind of line by line, it's kind of okay. Everything's sort of as expected or there or thereabouts. Cash flow's a little bit weak, and as a result, your dividend per share on that lower end. It's the low part of the mining and commodity cycle at the moment. You've got weak prices. You've got a weak China in terms of what it's doing from GDP growth perspective more broadly. And we've had inflationary pressures and labour costs go up, and that's been a significant headwind for lots of sectors, and the miners aren't immune to that. So look, for mine, BHP looks like reasonable value here.
I would have said it was a buy before the report because it was on a P of about 10. That'll go up now.
Right.
So, and by the way, of the ASX 20, it's probably the best value in there because most of them are really stretched.
Right. Yeah.
CBA and so on are absurd.
Yeah.
So BHP, we're showing it returning about 15% a year over the next 5 years, assuming commodity prices stay where they are, which we don't have a collapse.
All right, leaders and laggards, what led this market higher? In percentage terms, Star, with some corporate activity possible, up by 14%. HMC Capital, Judo, off the back of results, up by 9.75% apiece. Audinate, still making some good ground up in the wake of yesterday's result. And Hub24, we've got interviews with the CEOs of HMC Capital and Hub24 up on our website. We hope you can join and watch those or listen to them, however you choose to consume our content. I think I made a mistake. I don't think we spoke with HMC Capital. I think it was Reliance Worldwide, Hub24, BHP. All right. On the other side of the coin, we've got Challenger. Didn't report well. Very cool reception, down by 9%. Bapcor, Pilbara Minerals, Mineral Resources, and Sigma Health. In the small to mid-cap space, you can see Findi again in the wake of its update coming through yesterday, up by 10%. On the other side of things, though, we do always have these laggards, and we've got FBR down by 14%, Resimac, it reported down by 10%, and OFX shedding 7.5%. So what's on overnight? The New York Fed Empire State Manufacturing Survey and the NAHB Builder Confidence Indicator in the United States. We'll hear from a couple of Fed officials, Governor Waller speaking at a New South Wales seminar in Sydney, and San Francisco Fed President Daly. Both worth watching. In the Euro area, we get the ZOO survey of financial sector analysts, so a little bit of a read on economic conditions in the Euro area. And we get UK GDP growth data for the fourth quarter. The latest labour market figures will probably, Westpac says, reinforce the message that the UK economy has stagnated. Also, BOE's Andrew Bailey is speaking in Brussels. Here tomorrow, in the wake of that RBA interest rate decision where they flagged wages and a tight jobs market, we get the wage price index tomorrow. The RBNZ makes its rates decision. Of course, they went higher and harder than our own central bank. Also, U.S. housing starts and the FOMC meeting minutes in the States. So that's a wrap for the day with the CBO Australia Index off by 0.5%. The ASX also not gaining ground in the wake of that interest rate cut coming through. 10 out of the 11 sectors were lower, the best performer being health. In fact, the only performer being the healthcare space. And so that is the day that was. We look forward to getting you across all the details tomorrow. And don't forget, you can catch any of this great content plus our full reporting season coverage online at ausbiz.com.au.